Sorry, I'm a minute or two late. I just got stuck into my notes. I was just reading over my notes for tonight's session. If you can hear me, say g'day. I'm coming to you from Melbourne tonight, as usual, but not always the case. And tonight, we've got a really good lineup of content in terms of the companies that we're talking about. So I've got to be honest, all 5 of these companies that we're going to talk about tonight, I have, well, except for Wesfarmers, which owns Bunnings, I have very limited understanding of. So I'm coming at this today and tonight with you at basically the same level, with a bit of knowledge around the businesses, having studied them for the past 48 hours. So these are really interesting businesses, and I'm hoping you can help me out as we go through. We might mix it up a bit tonight because we've got a bit of a poll that I want to do a bit later on. I'm going to ask you effectively which of these 5 companies you want to put into the virtual portfolios that we're running. So we might start off with the companies, the 5 companies, and then move into the top 5 most bought and the top 5 most sold. I'll give you a hint. Okay, I'll give you a hint what will be the top 5 most bought and sold and how we'll play the game tonight. The number 1 most bought and the number 1 most sold is so obvious that we can't have it in the list. We can't have the number 1 as the guess number 1 most bought, guess number 1 most sold, and expect that anything less than 50 people are going to get it. So what I'm asking you to do tonight, and what I'm going to ask you just as a heads up, is I'm going to ask you to guess the number 2 most bought and the number 2 most sold, and indeed you can go in the draw, or you will win a value investor program and some free trades from Selfwealth. So I can see a few of you have already said good evening. G'day, Jason. Wonderful, Martin. Wonderful. Happy Tuesday. It's a bit of a different night. And why are we doing it on a Tuesday? Why don't we start with that? So obviously we love to have the anticipation for a Wednesday night. Everyone joins. It is a public holiday here in Victoria on Thursday. And because we happen to be the state of sport, we have a public holiday on Friday as well. And so with people right around the country mourning or taking some time off from work, we figured it would be better to do it tonight. So everyone can get on with their long weekends if they so choose and, go on a road trip or do whatever you want to do. But in any case, don't forget that any of the information that we share tonight is strictly limited to general financial advice only. It is not personal financial advice. No matter what I say, if I answer your questions, I'm strictly speaking at them from the point or perspective of investing. I don't know your personal circumstances. That's what you need a financial planner for. Yes, Jason, that's correct. Today is Victoria's Hump Day. So it's a 3-day week for Victorians. I'm a bit of a, as a small business owner, I'm a bit of a grump when it comes to so many public holidays, but I've just got to embrace it. After all these years, there's nothing that I can do, little old me here in Victoria, to say, we should be working more. It costs us too much for this. But I'd rather have a day off like we're having this week than one for maybe the horse races. So I can enjoy that at least. Vaughan said, I heard that it's also a holiday on Monday in Victoria. World Lumberjack Day. Is that just a rumor? Well, don't say that too loud, Vaughan, because it might actually become a thing. You never know in Victoria. So who knows? But for now, I don't think it is. It's not in my calendar. So anyway, let's get on with tonight's show. And I thought we'll just jump straight into it because there's so many companies I want to get through, and I don't want to just blow it out to 9 o'clock as I might usually. So I want to jump straight into it, and I want to ask you if you've got a joke, if you've got an investing joke for me, Rob, and the rest of the community, chuck it in the live chat, and I'll say it out loud, provided it's PG. We'd like to keep it PG here on Selfwealth Live. And don't forget, you can find us on any of the social media channels, including Twitter, including Facebook, all of those places. Just find us there, #SelfwealthLive. Okay, I'm going to get into sharing my screen, and feel free to jump around, ask me some questions as we go through. So here we are inside Selfwealth Live. Oh, the stock market was up today. I didn't even know that. So I very rarely check the market every day. I actually put out a tweet last week. Was it last week or this week? Where I said that basically, the stock market is down a long way, and in particular, tech stocks have been absolutely pummeled over the past year. Like, if we just I'll just bring up some names for you, like Twilio. This company does It's kind of like it does if you receive a text message from Uber. So when you go and you are standing and waiting for your Uber, and the driver says, "I'm here," and you say, "I'm here," but you're both not here. That is coming through the Twilio network. And so the company does all of these like communication as a service, as it's called. And so the company's been sold down massively over the past year. But even companies like Adobe, which many of you will know for Photoshop and Acrobat and Premiere and all the software that they've created, it is also down a very long way over the past year. It made an announcement of an acquisition this week of Figma, which is a new design platform, at an insane valuation. But it's another one that's down a long way. Salesforce, as we've spoken about on the show before, the world leader in software for enterprises, for managing customers, for managing sales teams, and it is down a very, very long way. And so many names are down a long way. And I put out this tweet yesterday, whenever it was, and basically said that a lot of these names are starting to get really interesting. So I think if you're a long-term investor, not to say that all of these companies are cheap, by the way, they could have been very expensive beforehand, before they fell, which I think is probably the case, but they're starting to become really interesting for many different reasons, in my opinion. And so I think that is, in a sense, really compelling for individual stock investors. So Stevie, he said, my portfolio, that's the joke. And Rob's given you a 9 out of 10. Not bad. I'll give you that too, Stevie. Like I've been hurting a lot lately. Jason, you've just said NBQ, and I don't know why you said that, but it is down quite a long way as well over a little while. So this is the NASDAQ 100 in the United States. So you can see it. This is the ETF version of it here in Australia, but you can see it's come off a long way as well. So I've actually got some nice slides tonight. I've actually taken some time to design it properly for once, which is nice. Coming up next week, we've got Kanish Chugh from Global X. Global X is the new name. If you're confused, Global X is the new name for ETF securities. So if you see Global X, that's what we're talking about. We're talking about new version of ETF securities, and Global X has been around the world for quite a long time. It's one of the world's biggest thematic ETF businesses, providing all different types of ETFs in the US market. And so if you see any of these ETFs, that's the name of the company now. So that's like, don't be concerned, I guess, is the key takeaway. It's just a new business. So and here we go. So it's not a new business. It's just a new business here in Australia. And Robert Milner. Rob Milner, I caught up with him. Miller, not Milner. I was talking about Washington H. Pattinson today. Rob, I caught up with Rob earlier this week. Was it earlier this week or last week? I'm getting confused with dates. And it was really fascinating to hear Rob's insights. It was the first time I've met him. And we were talking about private company investing. So Rob spends his time investing in public companies, so on the ASX, small cap companies, but also some of his time in private companies. So Naos actually runs a private investment company and a public investment company. And so he sees all different types of businesses, even businesses that you might see down the street and those types of things. They come across his desk. So we're going to have a lot of insights from him on that coming up in the next couple of weeks. So the topic for tonight is wide moats, big castles. And it comes from, I guess, mourning the passing of Queen Elizabeth, but also, I guess, welcoming King Charles to the throne. And I figured, why not talk about companies that have wide moats and big castles? And this, many of you will know, comes from the idea from Warren Buffett, which is that in business, I look for economic castles protected by unbreachable moats. And you will know a moat is the thing that goes around a business. I'll explain it in just a sec. If you think of a business, so say like Coca-Cola just does sugary water. At the end of the day, it just does sugary water. But its moat, its defensive features are its brand, the Coca-Cola drink, but also its distribution network. So those two moats protect it. It's got distribution network and the brand to protect its castle in the middle. And that's how it makes so much money, even though it just sells sugary water. So these are the types of businesses that we should look for as individual investors, as value investors, as opposed to ETFs, which you can just take a blanket market approach. If we're looking at individual stocks, here's a quote from Charlie Munger. The number one idea is to view a stock as an ownership of the business and to judge the staying quality of the business in terms of its competitive advantage. So what do I mean by that? What is that all? What does Charlie mean? What is that? Let's unpack that just quickly. So the idea is that when you buy a business, when you buy a stock, you want to view it as a business that you can own for many years. And the reason that you want to do that, which I'll explain in just a minute, is that a company can create more value than you can as an individual. So a company, which is just a group of people coming together to design products, services, or systems, can create so much more value. And in doing so, it can actually capture more of that value. So I'll give you an example. You can't just go out and create an Apple iPhone. Sure, if you had an infinite amount of time and you were a talented software and a hardware engineer, you could design an Apple iPhone. But it would take an infinite number of years for you to do that. But a team of people have done it and continue to do it. And that company creates so much value that then they can harvest some of that value for their own keeping. G'day, Pocket Full of Shell, and g'day, Fleur. Welcome to Selfwealth Live this week. And we're on Tuesday. I know it's a bit different, but it's great to have you here. Thanks for stopping by on a Tuesday night. And so what we're trying to do is we're trying to find companies that can stay in business for a very long time. Now, okay, this is all very abstract. How do we actually do that? So Morningstar, which is the global research company, which you all know, says that we have to look at a company's ability to maintain something called an ROIC, above its cost of capital. So what we're effectively saying here is the return that a company generates for itself. So I want you to imagine like a cash box. Imagine I slide across a cash box in it, in front of you across the table. You're sitting across the table from me right now, and I slide this box across the table. And I say, hey, Shell, hey, Fleur, put $100 into this box for me. And you go, okay. And you put $100 into it. Then after a year, you get $40 back. Then after another year, you get $45 back. And after another year, you get $50 back. And all you put in was $100. That is the idea of return on invested capital. You're not getting, if you think about that box being the business doesn't pay out all of its money in dividends. What it's doing is it's reinvesting inside of it, and it's producing a return on invested capital. So as individual investors, what we should be trying to find is the box that produces the most return. If you just think about it as return, we should be finding the box out of all the boxes that are available on the stock market, the one that returns the most. And not only should we be looking for the one that returns the most, but also the one that will continue to return the most. Because what happens under the laws of capitalism is that if one of those boxes is really good, someone goes and designs another box to sit right next to that box, and all of a sudden the returns go down because there's now two boxes competing for the same money. And so this is, in essence, what we're trying to do. We're trying to find something that protects that box, that castle, with some sort of like ring around it, something that protects it from other competitors coming in and stealing its share. And so the way we do that is we calculate the return on invested capital, which is basically just the profits that a business earns internally every year. It's not the dividends that you receive, it's what the company can reinvest in its business to grow for next year, and then reinvest again and grow again and again and again. Now, I searched through the ASX and through US markets, and I come up with a list of 100 companies that have exceptionally high returns on invested capital. So these are some of the best businesses in the world. And what I tried to find were 5 businesses that you would know, but you might not think about that often, and try and get us inside of these companies. And so we can understand what these companies do, how they do it, and what makes them so darn special. Because if you can find 10 or 20 or 30 of these in your lifetime, and you just hold on to them and you let them grow, chances are eventually your returns should begin to creep up towards the company's return on invested capital. Because over the long term, a company that is growing fast will eventually approximate, the share price will eventually catch up to that growth. And so let's just take one of these examples. Let's just take Otis, and I'll use, actually Otis is a bad example. I'll use the Home Depot, and I'll just use Google so we can get a bit of more context going back in time. So if we'll talk about how this business started, but you can see here all-time returns for this company, 311,000%. Now, Domino's doesn't have quite as long as a track record, but if we go all-time, 2,300. Now, Otis has only recently come back to the stock market through a split, so we don't have much of a history to go on. Wesfarmers, which many of you will know, is one of the biggest businesses in Australia. It hasn't been listed for that long in its current form either. So we can see here still up 380%, massive dividends paid along the way. Brambles as well doesn't quite trace its roots back that far, but if it did go back further, it was listed on the ASX many years ago. We would see that it's produced an exceptional return as well, because during this time it's also sold heaps of its different businesses and returned that money to shareholders. So let's go back and let's talk about these companies. So these 5 companies, I'll spend about 5 minutes on each one, and feel free to ask me any questions. But at the end, I'm going to ask you to vote on them. I'm going to ask you to vote which ones we want to put in the live portfolios. So I chose these companies just quickly, as you'll see here, because they have survived what we call a moat attack. And this is when a company goes through a period where there are competitors everywhere, where the industry slows down, where everything basically is thrown at it. So this isn't like Afterpay, right? Afterpay is only facing its first moat attack now that interest rates are rising. But these are companies that have been around for decades, in many of these instances, over 100 years. So they definitely have faced many threats. So let's talk about the first company. The first company is Otis Elevators. It's called Otis Worldwide. Now, I've got a little bio here on each of the companies that you can read, but I'll read it out for you. Elisa Otis invented the safety elevator in 1853. It first listed on the New York Stock Exchange in 1920, and then was acquired by United Technologies. That business is now called Raytheon, and you might know Raytheon for its space and its missiles and all of those different types of things, in 1976. And then Otis was spun out of the company in 2020, and it was put back on the stock market. And that's why if we go into Selfwealth and we look at the stock price, we see it doesn't go back that far. We can see it just goes back to March 20th, 2020, right in smack bang in the middle of COVID. As of 2022, 2 billion people ride on an Otis elevator or on an escalator every single day, which I think is incredible. And there are over 2.1 million units installed in the world. So to put some context around this, I think there are around about 16 to 17 million units in the world. So there's 16 to 17 million elevators or escalators. And so that would mean they have about 12% market share of the global market. And there are 4 massive providers. There's Otis, which is the biggest. There's Kone, Schindler, and I can't remember the other one for the life of me. But there's the 4 of them, and they're all massive, but Otis is the biggest in terms of new installations. By the way, as part of my research, I was looking into what it would cost to get an elevator in your house in Australia. And the minimum consensus, and I don't know if this was pre-COVID numbers, is $50,000. So if you have an elevator in your house, you can be looking at around about 50 grand just to get it in. And so this is a company, like you're going to realize this is a company that has been around the block. It's been around a very, very long time. So this thing here, this sign from an Otis elevator actually comes from the 1800s. And so this sign actually says, you can't really see it here, but it says, I think, 1,700 pounds is the capacity and a maximum of 11 people. So this is, at the end of the day, every one of us has stepped foot in an elevator or escalator. If you're anything like me, you think, wow, the escalator is a pretty cool thing, but you might be thinking the elevator going up to the 100th floor is actually very scary because you have to trust that that thing is built correctly. And that's basically what it comes down to when you choose an elevator provider. And it's basically who can get it in the building and who can do it safely. And at the end of the day, that's the business model. Put a big square steel box in a building and make it safe. Increasingly, all of the elevator companies are turning to trying to get the maintenance revenue. For Otis, that's around about 60%. And yeah, Dane, thanks. ThyssenKrupp, that's the one. Sorry, they're number 4. So those are the top 4. There are a few Chinese businesses popping up now, but those are the big 4 that I mentioned. So ThyssenKrupp, Kone, Schindler, and Otis. And so basically what it comes down to is when these are installed in a building, your builder has to choose a reputable company. And so they go with one of these big 4. Even in China, where the prices are, price is very important because these things aren't cheap, particularly if they're in US dollars. The thing is, even in that country, 60% of the new installations of elevators are done by the big 4 providers, Otis being one of them. So it goes to show that this is really important. Shell, you said, I have elevator nightmares far too often. I take it as a sign they're not the right investment for me. Well, maybe they are, Pocketful Shell. Trying to find something that allows you to overcome your fears. Maybe this is the thing. You can learn more about the business. But this company has an impeccable safety record. So if you step into an elevator, Shell, that has one of these, you can rest assured that there are over 2 million of these in the world, and they have an impeccable safety record. Like some of the places where an Otis elevator might be found include What's the Eiffel Tower, and many of the biggest buildings in the United States and in New York City. If you've been up to any of the tourist sites, chances are it's an Otis elevator. And so many of these, elevators are around the world. And I think the key thing to keep in mind is that this is a business that has the advantage over many of the competitors. And what it's trying to do now is move more into trying to get into the maintenance side of things. If we move to the next company now, and if you have any questions, or just keep these companies in mind, because I think the next companies will be interesting, but probably not as interesting to you as Otis. And I want you to vote on them at the end. The next company, which you'll know, is Bunnings. Thomas, you said yes, and people want to maintain them. So 60% of Otis's income, Thomas, actually comes from the maintenance. And what is happening is Otis over the years has started to lose some of those contracts to cheaper providers. But what they're trying to do now is make all of the Otis elevators connected. So I think there's about 25% of Otis elevators are what they call connected. If you can see me in the little screen, connected. And that basically means that there's more intelligence and software in them. And basically what it does is it forces buildings to use Otis as the maintenance provider and makes it easier for them to service those elevators. And so that reduces the cost, but also means that Otis gets the contracts. And so that's a big push. They want to get to 60% over the next few years. So turning to our second company, which, yeah, that's right, Eve. So elevator maintenance costs are mint. Martin, you said they charge quite handsomely for the service. Martin, can you, if you have some experience in this, I would be fascinated. Like I said, I'm still learning about these businesses. Can you tell us, if you do have knowledge of this, what it costs? But from my understanding, it's very expensive, and it's often based on things like cents per kilometer. So how far the elevator travels. If you're in a very densely populated building, which is very tall, that obviously means that it's better for Otis because it's moving further, but also that they don't have to have as many technicians servicing elevators because they're all in one building. Anyway, so moving on to the next company. And the next company, I've tried to blend ASX and global markets. But here we can see the return on invested capital. And I just got this data straight out of Selfwealth. So here we can see Wesfarmers, which is the owner of Bunnings, Kmart, all those, and Target, even though that's now closing down. It's the owner of all these businesses, but by far the most important business under their hood is Bunnings. And I just got the number here, return on investment 5-year average. And that's the one that I look at most because that tells us how well the business is investing its own money. Modern Da Vinci said, lame joke alert, why did the founders of Otis decide to go public? Okay, go for it. We're very intrigued, Modern Da Vinci. Please bring this on. This is your time to shine, my friend. So I didn't know this. I just called them all Bunnings, and I called them all Bunnings Warehouse. But turns out Bunnings actually has different labels for different stores. So there are actually 3 formats. I always knew there was Bunnings Trade. That seemed obvious. But all of the different stores are very prescriptive between whether they're a Bunnings Warehouse or a Bunnings. So I always thought they were just all the same thing, but they're not, according to the company. And okay, we've got it to Modern Da Vinci. Why did the founders of Otis decide to go public? They wanted to go to the moon. Very interesting play on words there, Modern Da Vinci. Very interesting play on words. Very 2022, very 2021 of you. Okay, so the company Wesfarmers has a return on invested capital of 10%. It was founded in 1886. And yes, it's 136 years old. Bunnings is 136 years old. It was founded by Arthur and Robert Bunning from England. It originally started in Perth as a sawmill, and it stayed there for a while. Jason's giving you 7 out of 10 to Modern Da Vinci. I think it's pretty good. You tied in like modern themes with kind of what the business does. I'll give you a 9. Selfwealth / Rob says he'll give you a 9 as well. I agree. Okay, so the company went public. So Bunnings actually went public and listed its shares on the stock market in 1952. And at that time is when it actually launched its retail stores. I think it made a few acquisitions. The first warehouse format opened in Melbourne, and it opened with Jeff Kennett, who is the former president of Hawthorn Football Club, but also the premier. It was bought by Wesfarmers in that same year for $594 million, which sounds like a lot of money. I've got a bit of a typo here. It was in 1995 that Bunnings gave rise to the Red Hammer. So this Red Hammer that you see on all the stores came about in 1995. So it's not actually that old, but it's still a marketing ploy and a bit of branding that stood the test of time. And the lowest prices are just the beginning, which you probably see on the ads all around the place, started around the same time. Many of you will know that there was a McEwen's brand, and they were all renamed in 1977. Now, the thing that's really interesting about this is they actually dropped, I don't know if you know this, but they actually dropped the lowest prices are just the beginning slogan and phrase in February 2020. So they actually dropped that, even though you can still remember it, that's gone. So interestingly enough, right, even though Bunnings was bought by Wesfarmers for $594 million, I estimate the Bunnings business alone could be worth $40 to $45 billion. And so if we compare that to the overall company with, all the other businesses inside of it, the whole company at the moment is worth $51 billion. So that means that Bunnings basically made up most of the company's valuation. So you get like Kmart and all that other junk basically on top as like a sweetener. And you're probably thinking, well, how did you get to that valuation? And how do you get to $40 to $45 billion? And the way I got to that, and I'll explain it when I introduce the next company, I think it's the next company, in that I looked at what other companies like this as standalone businesses. So without Wesfarmers being the overseer on top of it, what it would be worth. So Bunnings don't own many of the warehouses though, right? So is property part of that $40 billion. So the way I got to it, Jason, was basically what in a normal market, so where there are hardware businesses like Bunnings, what would they sell for? And if we look at the next company that I'm about to bring up, it sells for around about 2 to 3 times sales or revenue. And if you just did that, if you did 3 times, you'd be over 50 billion. If you did 2 times, you'd be around 35 billion. So many of the properties in which Wesfarmers sits inside of is actually owned by BWP Trust. So BWP is this business, which many of you will know. It's a trust, and it was spun out of Wesfarmers, and it owns many of the properties. It also owns a few properties with Harvey Norman in it, and a bunch of other retailers as well. But it's mainly Bunnings. So basically, what has made Wesfarmers a success, and I think it can be put down to its just sheer dominance. It has controlled via a virtual monopoly the retail market for home improvement here in Australia. But it's also done that during a period when house prices went, as De Modern Da Vinci might say, to the moon. So house prices have just risen unbelievably since the 1990s, and it has exploded. Its store count, its sales, everything about it has really shot the lights out. Now, the added benefit of Wesfarmers over these other wide moat companies, Wesfarmers pays a fully franked dividend. So you get franking credits with the dividend yield, which is super impressive and super important if you're calculating the return of Wesfarmers shares. So that's the second company. And Dane, you said, I lived in the UK a few years ago and remember Wesfarmers tried to expand by buying Homebase. If I recall correctly, they sold it after taking a big hit. I wonder how much of their success in Australia is due to limited competition. Dane, you hit the nail right in the head. So Wesfarmers decided to expand into the UK and do that via an acquisition, which was probably the most appropriate way to do it. It tried to introduce sausage sizzles, which are kind of like an icon of Australia's home improvement scene, where you go to Bunnings and outside there's a local charity selling sausages. And they tried to replicate what they did here over there. But what happens, Dane, and this is what we'll get to in the next company, what happens with a lot of these retail stores is once they get to such a powerful position, if you want, and I don't have one here in front of me, unfortunately, if you want the best Milwaukee drill set, or you want the top of the range Kelso wheelbarrow, if you're at Bunnings and you see a competitor coming, you say to these brands, if you sell to them, you're going to have to bring in a new product line, or you're going to be cut from our store. And so they can use their super competitive positioning. Obviously, they wouldn't be that explicit, but at the same time, there are certain nuances that come with owning the channel, so to speak. So I agree with you, long story short. Jay, you've said, hi, Owen, loving your podcast and all the educational videos. Well, thank you, Jay. Would you say Kmart and Target have a moat? Big W is there, but not as popular as Kmart. Thanks. No worries. My pleasure, Jay. So I would say no is the answer to your question. And so the reason that when we look at the company's financials, right, if we look at the ratios section here, Jay, and we scroll down to the management effectiveness thing where we have the return on investment. Now, you saw before that with Otis, its return on investment was 43%. And what that means is basically for every dollar of debt in the business and every dollar of equity in the business, it's investing and it's getting a 43% return every year, which is incredible returns. Because if you do that for 3 years, you've doubled your business, right? You've doubled the capital inside your business. Now, when you look at Wesfarmers, it looks pretty crap. It looks like 10%. That's not great. However, that 10% is currently being crowded by the Kmart and all the other operations inside the business. So Bunnings makes up most of the sales, but that doesn't mean it makes up all of the capital inside the business. So when we do that calculation, we have to be mindful that those other businesses are inside there. And that's why I say if we could strip Bunnings out of the overall business, we would find that it would probably be more valuable, but they don't want to do that because it's so important to them. So if we scroll down, and there's something called a segment report, which is at the back of the report, but I won't go there right now. So if we look here, we can see return on capital employed as a percentage is 77%. It's not the same as ROIC. Keep that in mind. It's not the same thing. Return on capital employed, 77% for Bunnings. But if we look at Kmart, Jay, we've got 23%, right? And we look at the other businesses like Officeworks, 17%, and so on and so forth. And so the point is here that we've got this A+ gold standard business here but then it's crowded by all this other stuff that goes in there. So I hope that makes sense. That's why I would say that those other businesses probably don't have the same competitive advantage. Kmart has a fantastic brand, and Kmart has a fantastic distribution network in Australia, but it's not a monopoly. It's not controlling the DIY home improvement market or just the home market here in Australia. Like you said, we've got Big W, we've got independent retailers, we've got Amazon that compete in that marketplace. So great question. So the other company, and this is tying into that point, Jay, which is the Home Depot. So if you've been to the Home Depot in the US and can tell me which one do you prefer, Bunnings or Home Depot, tell me which one you prefer. And so I think if Bunnings was its own business, Jay, we would probably see a return on invested capital that might look something more like this. Maybe not 35%, but maybe it's 20 to 30% or something like this. I don't know exactly. I haven't done the numbers. But this is maybe where we would get to. So Home Depot is basically Bunnings on steroids. So whereas Bunnings has 507 stores, Home Depot has 2,317. And those stores are spread throughout Canada and Mexico. And again, what we see with Home Depot is basically exactly the same thing that we see with Bunnings. It is by far, by a hop, skip, a jump, and a throw of a stone, bigger than the next closest competitor, which is Lowe's. And after that, you've got Tractor Supply, you've got Fastenal, you've got all these other businesses. By the way, Tractor Supply is a fantastic business too. So Tractor Supply is this one right here. And if we go to the financials and we go to management, ratios in here. We go to management effectiveness. I haven't looked at this in advance, but here we go. 19% return on invested. Tractor Supply is like a miniature version of Bunnings that only operates in the country of America. So, or the countryside. Whereas Home Depot is everywhere. So it's in everywhere you can think of is where Home Depot is. And so if we look at Home Depot, we've got return on investment here over 12 months, 37%. Over the last 5 years, 35%. Now, this company does have a bit of debt, so keep that in mind, but it's a truly massive company. You can see here it's a $287 billion company. That's US dollars too, so it'd be 400 here in Australia. So it's 10 times the size of Bunnings. And so Home Depot started in 1979 in Atlanta, Georgia, and came out with a store format that was so much bigger than all of the other stores. And it stocked, I think it was 25,000 different products. And so it just blew the competition away. It was started by 4 or 5 blokes, I think, and one of them was an investment banker. Jason, great question. That's a smaller ratio of stores for the population. So Home Depot could grow and have some upside. Potentially, Jason, potentially. There are things playing in Home Depot's favor, just like in Australia. In Home Depot's favor, we've got the trend of actually houses in the United States getting older. So houses in the United States getting older is a really interesting one because it actually means that more people are going to do DIY and renos and that sort of stuff. There's also increasing house prices in the US, at least at the moment. Like maybe next year will be a different story. And we're also seeing like just more houses being built. Not every year. Like in the next year, I would expect it's going to be a pretty tough year for Home Depot. During the GFC, Home Depot laid off, I think its sales fell 20% and it laid off a heap of its staff because these businesses, let's not forget, are cyclical. So these businesses do need the housing market to be strong because they need people to want to spend on a house. Like I was telling my partner yesterday, I was saying to her, if people start seeing their houses in Australia fall 20 or 30%, you can almost bet your bottom dollar that the Block and all of those shows, those reality TV shows that people love, are probably not going to be at the top of the charts anymore because people probably won't want to reno their house. And so that's the same thing that applies to these types of businesses too. That said, over the long term, as we become more affluent and as these businesses roll out stores and dominate, we will continue to see them incrementally grow. And this is the thing, and to your point, Jason, is the company, Home Depot, doesn't need to roll out heaps of stores every year to keep on winning. And the reason why is it's got the most sophisticated distribution network. So as it grows each store becomes more valuable because you're just bolting on another store. So the company went public in 1984, and that's why you see when we go to HD stock price, I have to use Google because Selfwealth only goes back 10 years, but you can see the stock is up 311,000%, which is quite incredible. So, yeah, so why wouldn't one buy Home Depot shares instead of Wesfarmers? So Vintage Restorations Australia, great question. Well, a lot of people prefer Australian stocks. In Australia, we have something called home country bias, and this actually is not just unique to Australia, but the Australian stock market only makes up about 3% of global stock markets, and yet people favour Australia because we're familiar with it. And so one of the things to keep in mind here is that you'll get franking credits with Wesfarmers. You won't get it with Home Depot because it's a US company. And in the past, in the past, this is a great question, Vintage Restorations. In the past, what would happen in Australia is that many brokerage accounts, so in this case, we're using Selfwealth, obviously, but in the past, you wouldn't be able to buy your Aussie shares and your US shares right beside each other. You would have to create a different account. Many brokers didn't offer the service, and it was this whole rigmarole. But now, thanks to platforms like Selfwealth, you can just buy this, sell that, buy this, sell that. So, and as Anthony says, the US companies don't always pay big dividends because of the tax treatment over the United States. Fleur, you've asked, you've said Wesfarmers is Australian, Home Depot would have to be paid in American dollars, and currently the exchange rate is not very good. That's a good point you bring up there, Fleur, is when you buy US companies. So one thing that happens, and I'm sorry if I'm just going to go on a quick tangent, but I know this is relevant to a lot of us. So if you look at the Aussie dollar here, right, and you can see just before the GFC, the Australian dollar would have bought you 97 US cents. But then during the global financial crisis, it dropped to, what did it drop to? Around 65 cents. And then it bounced back up, right? And then it's come back down. Like during COVID, it went down. And then now it's on its way down again as well. And what actually happens, and I touched on this, I think it was last week or the week before, is what actually happens is exactly the time that many Aussie investors want to buy US shares is exactly the time when the foreign exchange rate is pretty hard, because obviously you want to buy US shares when our dollar is higher and maybe sell when our dollar is lower. There's really a lot of people have particular views on this, but I would just say this. The short-term currency movements are really anyone's guess. Like no expert, I don't trust any expert on short-term currency movements. However, for me, it's very obvious that when the world economy struggles, the US dollar becomes more valuable because it is the world's currency. And you can see here that during the GFC, and you can see here during the coronavirus crash, the Australian dollar got weaker, meaning that the US dollar got more valuable. But when it comes to ETFs and those types of things, remember that you can just invest for the long term, and it generally all works out in the wash anyway, provided you're not going in one extreme or the other. So that's that's a roundabout way of saying we might not be getting the best deal if we buy US shares based on the currency now. For me, I just like the dollar cost average. I'll buy the shares regardless, to be honest. But obviously, I would like to take advantage. I remember when the Australian dollar was at parity with the US dollar, I was putting all of my Australian dollars into US dollars. And that was simply for the reason of taking advantage of what I expected to be an overvalued currency at the time. So Raptor13YB, welcome to the show, mate. Tuesday night, yeah, I know. Sorry about that. It's just one of those things. This show will be on a Wednesday going forward. It's only this week because of the whole weird public holiday situation we have in Victoria where, hey, we don't like to work. We're kind of like some Europeans where, maybe not a siesta, but we do like to take it easy. So that's why we're here tonight. So I'll quickly get through the next two companies and you guys got to vote. So Brambles is potentially the most boring company on earth. And boring, in this case, equals very good because Brambles has achieved some of the best results in Australia over a very long period of time. So Brambles originally started life as a butcher in New South Wales. Get that, a butcher, right? And now you probably see these wooden pallets everywhere you go, whether it's at the Woolworths, the Kmart, whether it's in Los Angeles or Rome, you will see these blue pieces of timber. And that's because the CHEP brand is owned by Brambles. It wasn't until many years later that they bought this. So this was like 70, 80 years after they started the business that they actually bought this CHEP brand and they expanded globally. And they bought it from the government. It expanded into the UK in 1975, which was first massive overseas expansion. In the 2000s, it began to unwind all of the things that it owned. So Brambles, when I say we look at the stock price chart before and it looks like the stock hasn't done much, which admittedly it hasn't done a great, not compared to the Home Depot. It has paid dividends in that time, but more importantly, it's paid out massive amounts of, it's sold businesses. And, in one instance, I think it gave back $2.9 billion or something. And so when you consider the whole company's worth 16, that's a lot of money. So that's something to keep in mind. So the business has 345 million pallets in circulation. But it also does crates and containers. It sold one of its crates business not too long ago. But there's actually something that I wanted to show you, and it's hidden behind this CHEP pallet. This is basically the way the business works. And maybe I can give ourselves a new tab here. And I'll get rid of all this other junk just so we can see it very clearly. And I'll give ourselves a different background. Just make it white. Reset. So here we can see in this chart, we can see that basically the way it works and the competitive advantage or moat that surrounds Brambles business is as follows. Brambles doesn't, if you order 100 fresh lettuces from a distribution warehouse and you send it to Coles, it doesn't just go and make those pallets for Coles. What it actually does is it reuses all of its pallets. So you can see here, for example, that if there's a pallet that's made for a manufacturer and that manufacturer, does widgets, and then that manufacturer ships its widgets to the retailer, like Kmart, then Kmart can send it back to Brambles and Brambles can then continue to do it again and again and again. And this is why the business basically is designed to be sustainable from day one. Brambles, as far as I know, I think it was from around about 10,000 global companies, Brambles was named as the number 7 most sustainable, which is incredible when you think about that for an Australian company. And so this is a business that basically continues to refine making these pallets, automating them, making more, finding better ways to make them sustainable. And so that's basically the story behind the business. And over many years, it has sold businesses like to Chubb Security and to other types of businesses like private equity, as it's just refined and got better at what it does. But it is a global business. It's headquartered in Sydney, even though it originally started in Newcastle. And so this business, I thought Brambles were the money trucks. The money trucks. So Anthony, that's what you just brought up. Yeah, so the money trucks. Brambles actually, they had this is the thing, they haven't just been, they started as a butcher. They didn't just start as doing this thing. They had so many different businesses. They owned ships for a time. They had ships. They sold their logistics business to Toll, and they sold their ships to Toll. Then they've done, you name it, Brambles have done it. And one of the things that they did is they did the armored cars. You said, I don't like those blue pallets. Can't use them for bonfires. Yeah, I know what you mean, Yoo-hoo. That's why they're painted blue, I'm pretty sure. So that's the thing, right? So you can just get some of the other crappy ones that someone else makes. They're trying, one of the things that Brambles are trying to do now is trying to make their network smarter, so they can track them. All right, moving on. So the final company that I want to mention is Domino's Pizza. And I want to mention Domino's. This is not the same Domino's that Scott Phillips brought to the show a few weeks ago. So remember when Scott came on the show, Scott was talking about this company. This is the Australian one. I'm talking about this one, which is the US one. That's right. Yeah, sold armored cars to Chubb. Yeah. I have Brenton. You have a Chep daybed. You know what? That's very popular, Brenton. A lot of people do just use the Chep pallets and use that as their bed frame. They just get a bunch of those, paint them, whatever color they want. It looks kind of cool. I like it. So Domino's is a very interesting business. Now, does anyone want to guess before? You may have read this already, but does anyone want to guess why Domino's has 3 dots in its logo? So why it has 3 dots in the logo? If you can guess that in the next 30 seconds, there's about a 10-second delay between you and I. Drop it in the chat. So, Jason, interesting comment about Brenton's bed. Tell me why it's got 3 dots. If you don't know the answer, I'll fill you in around about 5 seconds. 5, 4, 3. Not syllables, Jason. 3, 2, 1. Okay. So, the reason that Domino's has 3 dots, close to modern Da Vinci, you're probably the closest with your guess, is when Domino's first started, it was actually 2 brothers that bought, I think they're brothers, they bought into this pizza business, right? And when they bought this pizza business, they bought it for $900. It's called Dominic's Pizza. But after 8 months, one of the brothers said, I don't want to do this. I don't want to leave my job at the post office. You can have the business. And what the other brother said was like, okay, well, you can have the Volkswagen Beetle that we use for deliveries, and I'll take your part of the business. So I don't know what a Volkswagen Beetle would be worth in 1960, but I can't imagine it was a lot. By 1965, the company had 3 stores and changed its name to Domino's after a delivery driver came back to the place and said, we've got to change the name. Domino's sounds like a better name, because the original Dominic, who was the original owner of the business, said, you can't use my name on other stores. You can only use it on this one store. And so they had to change the name to Domino's. And at this time, they only had 3 stores. And so Tom, who ran the business, wanted to put a dot on the logo every time he started a new store. And because he had 3 at this time, he put 3 dots on it. But then what happened is, within 2 years, Domino's had 200 stores. So he couldn't fit 200 dots on the logo. So he stayed with the original 3 dots. And what's incredible about this business is they did that. Today, a good Beetle will get you $20,000, says Go Hard Productions. That's after dropping about 10K into it. Domino's still a way better investment. Yeah, I reckon. I'd love a Beetle, like a Volkswagen Beetle. I don't know how fuel efficient they would be, but they're really iconic. So the crazy thing about this business, right, is it went from 3 stores to 200 in 2 years. And I've said this before on the show, but the easiest way to get rich is to use other people's money to do it. And that's what Domino's figured out super early. It figured out that if they could get franchisees to pay Domino's for the license to use the brand and all of that, they could make a shed load of money. And so through franchising, Domino's exploded its store count. Right up until the time in 1998 when Tom, the original co-founder, retired, he sold his 93% stake for $1 billion. Domino's is today worth $12 billion. But I want you to imagine something. In 1998, let's say Tom here had discovered index funds. And I went back and did a calculation and found that if he just put all of his money in an index fund, like the S&P 500 index fund, which is IVV, or SPY in the United States, he would have $4 billion today. So now the company that he actually sold his stake to was I think it was Bain Capital. So he sold his company to a private equity company, which later sold it via the stock market, via an IPO in 2004. The majority of Domino's stores are as part of a franchise network. So if you actually look at Domino's financials, if you look at Domino's financials, what you will see all the different lines going down the page. You'll see revenue at the top, which is just like normal revenue. But then you'll see, and that's for the stores that it owns, but then you'll see franchise fees, and then you'll see what they call supply chain. And the supply chain revenue is if you run a Domino's store, you have to buy everything through Domino's. So if you and I go and start a store just down the road here, and we say Domino's, we want it to be a Domino's pizza outlet. They go, okay, but we have to supply all of your ham, all of your pizza bases, all of your machinery, all of this, all of that. And so Domino's revenue actually goes up when the stores do better. But not only that, they also take a clip of revenue, and the franchise network actually pays for the marketing. So I pay Domino's, or we would pay Domino's up here, and then Domino's would do the marketing for us. A classic, I guess, franchise play. And the Australian business of Domino's, which is on the ASX, it's one of what we call master franchises. So it sits and it has a number of geographies that it controls, but it's not the only one. There are 4 of them. Basically, Domino's business model, the Domino's US business model, is basically in international markets, let everyone else do the heavy lifting for us. In the United States, we'll still let them do the heavy lifting, but we'll also do some of our own stores. And so that's why you see here, still, even in the United States, most of the stores are franchised. And the company still has growth potential. Like, it still has places that it can grow around the world. China would be a good example of that. It sold some of the licenses to different groups over the years, but it has ways to do it. Jake, you've said, I've owned Domino's, that's the ASX version, since 2012. It's been very profitable. Jake, you're not late to the party. Just thanks for coming along. So Stevie, you've said, I wonder if the brothers had a good relationship after that blunder, $1 billion. Yeah, imagine if you started a business with your brother or your sister, and one of them said, I want out, give me the Volkswagen Beetle. And then in 20 or 30 years, you go, oh, yeah, I sold the business for $1 billion. And I collected about $1 billion of dividends along the way. So, yeah, how's the Beetle going? I don't think you'd bring it up. Okay. So now that I've laid out all of the different businesses for you, I want you to vote. So, Rob, if you're still there, if you're with us, can you please put in the chat, and if you're not, I will do it. Can you please put in the chat a poll for everyone to go on, which is, which of these companies do you want to put in the portfolios? So do you want, and we can only have 4 in our poll. So we've got Otis, Wesfarmers, I don't know, whichever 4 Rob picks, we'll vote on in the chat. So just one moment while Rob spins that up for us. And Brenton, you asked, did Nick, the original owner of Domino's, go on to do great things? Or, well, we don't know about what happened to Nick, Brenton. We can only assume that he never ate Domino's pizza. So that's all we can assume. Jason, you've said, did you think the franchise model was a good investment? You're asking Jake about what he liked about it. Jake, you said, fun fact, I've been a passenger in Don May's Ferrari. I used to be a franchisee. Oh, well, there you go. What? You left after 2 years. Wait, what? Jake, you have to tell us. There has to be more of an explanation here. Why were you in his Ferrari? Don May, by the way, is the founder of, the CEO. Don May is the founder. Oh, what am I doing here? Don May. He's the founder. He's the CEO of Domino's Australia. Okay, so Rob's put it in the chat. Which castle would you want to live in? So obviously, when I'm saying castle, I mean which business would you want in your portfolio? So I can see a lot of votes coming in for Wesfarmers / Bunnings, and Otis gets the least. Wow, poor old Otis. Remember that show Milo and Otis? Was that a show or a movie? Oh, that was a blast, wasn't it? So okay, so it's clear that everyone said Wesfarmers. Well, guys, come on. Show a bit of global diversification, would you? I can see that Brambles and Home Depot was next. So, and then Otis was last. Domino's would probably be up there too, but we've got Wesfarmers. So everyone's chosen Wesfarmers, which is great, fantastic. Wesfarmers obviously pays fully franked dividends, and I realised it wasn't actually in our portfolios. So I will put all these others down the bottom, and I will relegate Wesfarmers, and it will go into our low tofu portfolio. So this is the portfolio that includes like the lower risk options. Let's see if I've got it in Selfwealth Live. I'll see if I've got it in my sheet here. I want to see if I predicted what you guys would say. Let's have a quick look. So on my sheet, I have Wesfarmers under our low tofu portfolio because I figured you guys would say Wesfarmers because it's familiar and because it's a good business. I went with Otis for the high stakes portfolio because I think Otis is actually a little bit higher risk. And I actually like the business model of Otis, so I'll put that here and I'll add that to the high stakes portfolio and begin tracking that. And the reason why I say it's a little bit higher risk is Otis actually has quite a bit of debt, and it's only recently been on the stock exchange. So we have to give it a bit of time. What would be my choice, John? To be honest, I would probably go like to be honest, John, I could find a spot for all of these businesses in my portfolio, one way or another. But I think if I was building a large portfolio, I would have to go with Wesfarmers simply for the franking credits and because of its competitive advantage. That said, I wouldn't be turned off by putting a large stake in things like Home Depot because it's such a staple. I'd probably want to see what happens early next year with the US housing market before I did that. So here's the rest of your story, Jake. Okay, so there was a meet and greet with the CEO and the board of Domino's Pizza. As you can imagine, most franchises don't have Australian as a first language, and were there less for the meet and greet and more of a whinge. Interesting. And this is how you got into the Ferrari? Pocket Full of Shell, you said, I like Home Depot, but I'd be double dipping with my ETF. Just can't get behind Domino's since working at a pizza store in my youth. You know what? I couldn't get behind Domino's since I had one of those pizzas in my teens, but now I actually would go for it. So I actually like Domino's pizza too, to be honest. I had a good chat with the big boss, says Jake, and we went for a spin in his Ferrari. I have photos somewhere on my Facebook. Well, yeah, I don't know what that says, Jake. Like, if I'm rocking up to a congregation of, my colleagues, if you think of them like that in the network, what would it say if I rocked up in a Ferrari and everyone's rocking up and is complaining about having to pay extra on their franchise fees? I don't know about that. Okay, so as we come to the end of tonight's show, as promised, we have the top 5 most bought and sold. But what I really need is I need your number 2. So your number 2 most bought and your number 2 most sold, please. Remember, this is for last week. This is the week Friday last week. So it's not for this week, it's for last week, if that gives you any hints. If you can just drop them in the chat now, tonight's winners will receive free trades from Selfwealth, a free pass to the Value Investor program on Rask, and you'll get my digital admiration and praise. Through this camera, you will get some praise. Jake, you've said, as you guys get in your submissions, I will just read off Jake's message here. Regarding franchisee, there was a scheme, buy an existing store for $1, grow the business, and after 24 months, Domino's corporate buys it back off you for a good price based on the difference in sales. Oh, wow. Did you do that, Jake? Is that what you did? So you could buy a franchise for $1, like an existing one. Basically, here's the keys, take it. And then if you got to a certain amount of sales, interesting. Todd, you've guessed LKE most sold. Wait, no, most bought LKE, most sold Core Lithium. We've got BHP sold, CBA buy. We've got Sol, Avas, Go Hard Productions. We have most bought. We've got Pilbara from Josh with Whitehaven sold. This is a good list. Why you guys do that? I'm going to just jump into my account here. I'm just going to have a scroll around and I'll look at some things. While you do that, I'll give you another minute. So Jake said, yeah, it was a bit odd. The big boss rubbing his wealth in our faces. Yeah, I mean, I wasn't there to understand the context, Jake, but I just find it, I don't know, I feel a bit weird if someone's rocking up in the Ferrari. Maybe that he's trying to signal that you could have this too. And I don't know. Yeah. So Brenton looks like Owen contemplating buying a pizza. Well, Brenton, I tell you what, I probably wouldn't have the time to work in a pizza shop right now, at least not full time as my own. I'd happily do it at night because I love the atmosphere of a pizza shop. But if I could buy one for $1, if we talk about return on invested capital for a moment, if I could buy one for $1, hire someone else to run it for me and then sell it to Domino's for, one-time sales or one-times profit or something, well, sure. Yeah, I'd do it. It's good return on invested capital. Springtime's guest, most bought PRN at 60 cents. Bought PRN at 60 cents and at 50 cents. John, you've said LKE most bought, PLS most sold. Yeah, yeah, Jason, for $1, I'll take 10. Okay, here we go. We're going to get it. We're going to get to it. Jake, you said, I certainly did. I paid myself a nice wage for 2 years. We got a nice payout when they brought it back from me. Yeah, wow. You just give up 2 years of your time, just do that. Scruffy, you've said, liked your 15-minute video explanation of the stock market, Owen. I sometimes struggle explaining it, but this was a really simple way to describe it. Scruffy, thank you. I think you're referring to the video that was on Twitter and on YouTube. Well, thank you for your praise. Jake, you said, I got $52,000 when Domino's bought it back from me. Well done, mate. Well done. So thank you for sharing your business journey and life story with us. I find that fascinating. You bought it for $1, you paid yourself a good wage, and then you sold it. I mean, great. Fantastic. Good on you, mate. Seriously, that's wonderful. Like, spotting those types of opportunities, it's not for everyone, but you did it. Okay, so everyone's got their guesses in. Remember that when if you win tonight, you have to email us marketing@selfwealth.com.au. Marketing@selfwealth.com.au. Okay. Also, don't forget that Big Swinging Stocks is in a podcast player near you. We've got some great episodes coming up. Alex and Rob putting it together. Fantastic episodes out recently. You can find that in Spotify. You can find it in Apple Podcasts, wherever you get your podcasts. Go and have a look, subscribe, like it, leave Rob a very nice review. Alex will really appreciate it too. Okay, so let's get to the top 5. And I've got my list off to the side here. I'm not going to do what I did a few weeks ago and share the list in front of everyone. So in at number 5, back to this one, not that one. But in at number 5, we've got Fortescue. So Fortescue in at number 5. I'm just going to put this in the chat. 5 was Fortescue. So in at number 5, we've got Fortescue, which you all know. The business itself, really solid, but I've noticed actually that in terms of forecasts, a lot of users, a lot of analysts are actually forecasting lower valuations, and you can see them coming down in recent times. So we've got, just in the last 3 months, analysts have changed their valuation from $19.60 odd to $17 and now down to $16. And that's just with iron ore prices. They're basically trying to say, iron ore prices, quite unpredictable. So, just trying to, I guess, get in front of that. It appears we have some spam coming through the chat. Sorry about that, guys. So in at number 4, we've got SYA, so Erna Mining. We've covered this business before. Still kind of at the pointy end in terms of speculation and so on and so forth, with no revenue to speak of. Now, in at number 3 on the most sold list, we've got Core Lithium. Core Lithium, a lithium mining company or a lithium exploration company, one of the top performers we've covered many times. In at number 2, now this is where people are going to not like me as much. Okay, in at number 2 is Pilbara, how do we say this? Pilbara Minerals. In at number 2, and that means in at number 1, which we are kind of excluded for tonight, is Lake Resources. So Lake Resources in at number 1 on the most sold list. So just in reverse order, we've got Fortescue, Sayona Mining at number 4. We've got Core Lithium, Pilbara, and Lake. Now for the most bought list. I don't know if any of us are still in the game, but I hope we are, because I don't want it to be too difficult. But it is exactly the same companies, just in a different mixed up order. So in at number 5 in the most bought, we've got Sayona Mining. In at number 4, we've got Fortescue Metals. In at number 3, we've got Pilbara Minerals. In at number 2 on the list, we've got Core Lithium. And in at number 1, we've got LKE yet again. So I excluded LKE But in at number 2 on the most bought list, we have Core Lithium. In at number 2 on the most sold list, we've got Pilbara. So keep that in mind. If you were the lucky winner from tonight and you did guess Core Lithium at number 2 on the most bought and Pilbara at number 2 on the most sold, you're in business. Send us an email and we'll hook you up with the Value Investor Program. I think quite a few people have now got the Value Investor Program and some free trades through these sessions. And Stevie, yeah, very close. So Rob's just given a plug to the new podcast. It's available in the feed there if you just look at the comments. New Big Swinging Stocks podcast here, by the way. Spoke to Molly from LFC. Get a load of that. So Go Hard Productions, what have you said in terms of your question? You've said, is that saying most bought and sold equal day trading? So I think what happens with a lot of these Go Hard Productions, what I actually think happens in this list, right? If we've got leg here, I think a big part of what ends up in this list is, as you say, a lot of speculators and a lot of investors trading to buy different stocks. So, we don't look at this list and go, this is a great list of companies. We actually only look at this list to show you what other people are buying and selling so that then we can do this giveaway, basically. And so you can see it here, you can see the reasons. But I do find some of the other data pretty interesting. Like when we look at who owns it in the community and how well have they performed, I think that's where the true power of this data comes from. So that's why we do it, and that's why it's there. Jake, you've said, the thing about Fortescue, once FFI takes off, it could make new revenue sources for them as they sell their technology to other operators, make their share price less related to iron ore cycle. Yeah, true, but it will take a little while. And John, very close indeed. So that's it for tonight, guys. We've just got the final quote, which we'll end with, which is from Bruce Berkowitz, who says, often investing is more liberal arts than it is business science. Liberal arts than it is business science. And Bruce here has some really fantastic investing track records across the different funds that his company runs. But you might remember a book called The Last Liberal Art by Robert Hagstrom that I mentioned a few weeks ago. And this kind of shares that sentiment that understanding investing actually has a lot more to do with understanding more than just accounting. It's actually understanding the world around us. If we think back to these companies, right? Imagine Otis Elevators 30 or 40 years ago. Imagine Wesfarmers in the 1990s before it really exploded throughout the rest of Australia. Or the Home Depot, only started in the 70s. Brambles, a business that had been around for 100 years and yet didn't get to the stock market until the 1950s and didn't buy CHEP until that time. Or Domino's, it just makes pizzas. There are some fantastic, features of these businesses. But the way you would have identified them is basically as follows. You would have looked at the businesses and said, what about these businesses is going to keep my competitors out? And how do I know through my qualitative judgment of the business, through what I know about the business itself, how do I know if it's going to stay around? And that's basically where this quote comes in, is sometimes in investing, it's not about what you can justify in a spreadsheet, it's what you can glean from doing your qualitative research. And that's basically what long-term investing is. So thank you for sticking around tonight on a Tuesday. I hope if you are in Victoria like me, or even if you're in another state, you're connecting the public holiday with the weekend. I hope you have a wonderful long weekend. Don't forget the stock market is open for quite a bit. Not all of it, I don't think. But I started listening to The Psychology of Money on your recommendation, says Pocket Full of Shell, and didn't realize it was narrated by Chris Hill. It is Pocket Full of Shell. It is narrated by Chris Hill, the host of the Motley Fool radio show in the United States. Also a friend of Morgan Housel, the owner or the writer of the Psychology of Money. So, Jason, you said, I'm going to go and buy Brambles. That butcher is a cut above the rest. I see what you did there, Jason. I could have used that as my joke for next week if you send it to me privately, but okay, we'll take it. Very well done. John, you said definitely a satellite investment. Yeah. LMG. So Owen, would love for you to look at LMG this week and what their prospects look like. I feel like it has lots of upside. Why don't we just take a quick look at that now, John? I don't know much about it. Let's have a really quick look before the end of the show. LMG, Latrobe Magnesium. So 8.7 cents a share, John, 138 mil market cap. I like to see revenue in that column. I don't like to go too early stage. Like this is a bit small for me, to be honest, John. It's a bit on the speculative side. I do like to, if there's a business like this and it's very early stage, I do like to know who's involved in the business. So make sure that the management team has plenty of skin in the game. Make sure that they're incentivized correctly. So they're not just paying themselves stock options, because if the stock price goes up, they'll just hit the exits and they'll sell. Make sure they've got a track record. A lot of these mining companies, like in particular the lithium mining companies, have CEOs and management teams with pretty wonky track records, to be honest. So make sure you do a bit of digging. Search online, look at the CEO's track record. Once you can get a management team that's aligned, has a really good track record, those are the two strong, and as you say, definitely speculative. Those are the two strong indicators for me when it comes to any type of business. As we move further out the risk spectrum, one of the things, John, just as an aside, and this is not what you asked, but it relates to this. When you look at venture capital companies, so if you're investing in very early stage companies, one of the most telling things that you can think of is actually asking yourself, who went with the founder? And this is a question that you can ask of any new business that starts up. When the founder went and started this business, or the founders went and started a business, who went with them? And if you can figure that out, if a company starts and it can attract talent earlier on, it means it's the people who know what they're doing are on the ground level and they want to be there in the trenches. And so when I look at really early stage companies, I'm paying even more attention to the management team in the background. So, Jake, I don't know. This is sorry to change gears, John, but John, happy if you want to send me something on Twitter or something like that. Send me what your thoughts are, and we'll go from there, mate. Jake, you've said, fun fact: if anyone invests in AGL or Origin, if you bought 10 years ago, you'd have lost money. I back tested my portfolio today and decided to dump AGL and Origin. Well, Jake, humility at its finest. Thank you for sharing that. It has been a pretty tough run. I don't know if you included franking credits in your back test, but it's one of those things. Brenton, you've asked, when I buy an ETF, who gets the voting rights? Good question, Brenton. And at the moment, the ETF provider gets them, not you. There's big change underway where a lot of the big index fund providers are trying to find a way where you can have more of a say on voting matters. And they're trying to make their voting record public as well. As Martin says, the ETF sponsor. Okay, guys, that's it for today. We'll be back next Wednesday night. Say g'day on social media, follow, don't forget to hit subscribe on the YouTube channel. If you haven't already, this is your first session, please hit subscribe. It's the number one thing that we look for when we judge how well we're doing with the show. So please hit subscribe. We're over 6,000 subscribers now. We want to make it 10,000 just so we can kind of get enough people supporting the show. So as Damon Da Vinci says, smash that like button and the subscribe button. That allows others to find the channel. So thank you so much. I hope you enjoyed tonight. It was a bit technical, but I like these ones. So I'll see you next week. Rob will see you next week. Thank you all. Have a wonderful night. And don't